Welcome, student, to the series of lecture on CFA and FRM preparation. And today's discussion is around bond future contract and specifically around the cheapest to deliver bond concept in the future contract of US Treasury bond. Okay, so we are talking about future contracts. And therefore, the prerequisite for these lectures are your concepts on derivative. So please revise your concepts on derivative and then come back to these concepts. A basic understanding of future or forward contract will work. So we are talking about a future contract that is written on a bond, but whose bonds? Treasury, US Treasury bonds, which are called as T bonds. So US Treasury issues three different kinds of fixed income instrument. The number one is T bills, which has a maturity between 1 month to 1 year. T notes, which has a maturity between 2 year to 10 year, and T bond, which has generally the maturity between 20 year to 30 year, or specifically you can say 20 year and 30 year. So these are the different kinds of fixed income instrument that US Treasury issues in the market. And we are talking about the future contract written on these Treasury bond, the T bonds, which has a maturity of 20 year, 30 year. And these future contracts are generally traded in the Chicago Mercantile Exchange, and Chicago Board of Trade. Okay. So there is a future contract between two party A and B where A is long and B is short, and they are trading the future contract on an underlying asset. The way any future contract is being traded on certain underlying asset, that underlying asset is a bond which has following characteristics. The face value is $100,000, coupon 6%, and maturity exactly equal to 15 year. So in this future contract, A and B are betting or buying or selling a specific treasury bond which has a maturity of 15 year, coupon 6%, face value 100,000. And on the maturity of the contract, say the maturity of the contract is 6 months. So at the maturity of the contract, on the maturity of the contract after 6 months, A will buy this underlying asset from B at a predetermined price that is called as future price. Now, the way the future price are quoted is very specific. They are quoted in percentage. So if it is written 95, it means 95% of $100,000 is the future price. If it is written 101, it is 101% of $100,000. So it is $101,000 or $95,000, or it could be 87%, $87,000. Okay. This is the way they quote the price. Most of the market has a specific way of quoting the price. So CME and CBOT quote the price in percentage of the face value. That's it. It's nothing fancy. And we know that the future price are predetermined. You cannot change it once fixed. So they are quoted in percentage. Okay. What is the problem? There is a problem in this contract, a very specific problem that even CME and CBOT are aware of. Everyone is aware of. The problem is you're saying that at the maturity, B will deliver or B will sell a bond, a treasury bond with an exact maturity of 15 year, not 15 year 1 second, 15 year, or 15 year 6 months, 15 year. And it has to have specific coupon of 6%. Not 6.5, 7 or 8, 6%. It's too restrictive. Okay. It's too restrictive. Even the maturity itself is too restrictive. So what are the different flexibility any exchange, whether it is Chicago Mercantile CME or CBOT, any exchange allows? Those flexibility are, instead of delivering this specific bond, you can deliver any bond which has a maturity of between 15 year to 25 year. It will work. And the coupon could be anything. It could be 6%, 1%, 0%, whatever you feel like, you can deliver. But I'm saying that the future price was fixed. That was 95,000. That was fixed. And now B can deliver any bond. Is it fair? If we can observe that this is not fair because the seller will try to deliver a cheap bond, and that's why called as cheapest to deliver bond, a cheap bond, a bad bond, or a bond of their own preference, then we have to apply a adjustment. We have to apply an adjustment to this future price. That adjustment is called as conversion factor. If seller is going to give me a good bond, I will increase the price with this conversion factor. If the seller is going to give me a bad bond, I'll decrease the price with a conversion factor. But what is that feeling? How CME or CBOT decide that? It depends upon the coupon itself. They just look at the coupon and decide it. So they say if you're giving me a coupon of 8%, it means you are giving me a bond which is giving me a coupon higher than the previous coupon of 6% only. So it is a good bond. And that's why I'll apply a conversion factor of 1.1 or 1.2 or 1.3. If you're delivering me 6% coupon bond, then it is identical to what was the underlying asset I was expecting, and therefore I'll give a conversion factor of 1. And if you deliver me a treasury bond which has a coupon of 4%, then the conversion factor would be zero point 0.9 because I perceive it as a bad bond. Okay. So let's look into the example that how it will get adjusted and what would be the final price, and should we call it as a final price or there is a different terminology to it. So the example is a treasury bond future contract which has a maturity of 6 months is traded at 95. When you see 95 or 96, it means that it is at percentage. So 95% of what? Of the $100,000. So that is 95, that is 95,000. Okay, it is $95,000. The seller will deliver a bond of coupon 8%. Now it's not 6%, 8%. So I have to change this price. That leads to a conversion factor of 1.2. So it is a better bond. So I should increase the price, find the final invoice price. So it is just simply multiplication. That's it. You have to just multiply with the 95% of 100,000 into conversion factor and you get the final invoice price, or you can call it as the specific name to it is the principal invoice price. This is the final price that A will pay to buy this bond from B if B delivers a bond which has a coupon of 8%, not 6%. Okay. Now, have you felt they were not looking into the maturity? And understand, maturity also play a very big role in determining if the bond is a good bond or a bad bond, and also depends upon the market scenario. How come? Let's see. If say there is a bond which has a maturity of 25 year and another bond has a maturity of 20 year. In both of them, the coupon is 8%, 8%. And everyone got to know that interest rate is going to rise in the market. Going to rise in the market. How come? Because the US government, the Fed came and wanted to convey this message that we are going to increase the interest rate. So what will happen to the bond price? It will fall, and it will fall at the rate of what? Duration. And where the maturity is higher, the duration would be higher. So which bond you won't like? This bond, because it will have a higher duration because the maturity is 25 year compared to 20 year. So suddenly the price of this bond will start falling drastically with this just expectation in the market. Okay. So this bond will start getting perceived as a bad bond. So what I'm trying to highlight that just looking at the coupon, which CME and CBOT is doing currently, nobody can apply the correct conversion factor because they overlooked what maturity. And because of that, every seller is aware that I can make a good profit by choosing the bond properly. So actually the seller in the contract can deliver any bond from the universe and say these are the bond A, B, C. I can deliver any bond. I'm going to receive a fixed settlement price or the principal invoice price, which is 95% of 100,000 into conversion factor. So what I have to do? I have to calculate my profit. This is the cash that I'm going to receive from the buyer. What is that cash? The future price into the conversion factor. That is the price that A will pay. And to deliver any one of the bond, whether it is A, B, or C, as a seller, I will incur a cost. That cost I'm calling as cheapest to deliver cost or cheapest to deliver bond cost. And I'll try to maximize my profit. Understand, A will pay you something. What it will pay? They will pay future price, but not only future price, because in the treasury bond future, there is a concept of conversion factor. B have to, or the seller have to deliver what? Bond. Bond will have a cost. If you will go in the market, it will incur a cost. So there is a cost. The difference between the two is your profit and loss. You will always try to maximize your profit. And then you will decide as a seller which bond to deliver. So see, there are three bonds, bond A, B, C. A has a coupon of 8%, B has a coupon of 8%, C has a coupon of 6%. Maturity is this. Based on the coupon, CME decided the conversion factor, which is 1.1, 1.1, and 1. You can understand why it is 1.1, 1.1 identical, because they decide only on the basis of the coupon, not the maturity. The bond price of bond A in the market is 141. Bond price for B is 145 and bond price for C is 143. The future price is 148, 148, 148 because future price will never change. That is fixed. You have to change it with the help of what? Conversion factor. So you have to calculate what is the profit if I deliver bond A, if I deliver bond B, and if I deliver bond C. So if I deliver bond A, I will receive 148 into 1.1. That's it. Into $100,000. You can calculate that. Minus the bond price, which is 141. That is what my cost is for bond A. For bond B, it is 148. Again, conversion factor remain constant. I'll receive 148 into 1.1 from the bond from the future contract buyer minus the cost of the bond, that is 145. Definitely in these two, I'll go with this because here what I'm receiving is constant, but the cost is lower for bond A. But let's calculate bond C if it wins in the profit from bond A. So 148 into 1 minus 143. So let's calculate for bond A and bond C. Okay. So 148 into 1.1 is 162 minus 141. So this is the profit of near about. So this has a profit of near about 21.8. This has a profit of 5. Which one you will like to deliver as a seller? Because you can deliver anything. So you will deliver 21.8, and that is your cheapest to deliver bond. And everyone tries to do the same. They try to maximize the profit. Okay. So what is the mechanism to calculate what would be the cheapest to deliver bond? In a very simple one liner, it is you always try to maximize the profit as a seller. You try to calculate what you will receive from the buyer, which will be future price into conversion factor always, and you subtract the cost to buy the bond in the market. Only one thing, one caveat you should remember. You should always add and subtract the accrued interest. Now, what is accrued interest? If you're going to buy or sell any bond between the coupon dates, then you have to pay the accrued interest. Okay. So the profit formula is fixed. That is FP into conversion factor minus cheapest to deliver. But this formula is only valid if you are buying or selling the future contract or the maturity of the future contract is on the coupon date. If it is not on the coupon date, you have to calculate the accrued interest. And if you calculate the accrued interest, then the future contract buyer has to pay what? Accrued interest. And even the person who is buying from the market has to pay accrued interest to the bond seller. At the end, this accrued interest will cancel out, but still, the complete formula to calculate the profit is future price into conversion factor plus accrued interest minus cheapest to deliver plus accrued interest. With that, we have completed the discussion of cheapest to deliver bond in the Treasury bond future. I'll pause here. Thank you. Have a nice day.